Welcome to Alpha Insights. I'm Hope. Today we're unpacking a tight option setup in a small cap name. And my guest is Jessica, who looks at these market mechanics every day. Remember, if you have questions as we go, you can ask us at stockalpha.ai.
Thanks, Hope. Happy to be here.
So, Jessica, start us off. What's the quick read on this setup?
Okay, in plain English, the stock had a big one-day jump and it closed just under a big wall of short-dated call options at the $9 strike. That wall is what traders watch because it can force dealer hedging if the stock moves through it.
Give us some color. How big is that wall?
There are 12,686 call contracts at the $9 strike for the near-term expiration, and another chunk stacked at $10 and $11. All told, between $9 and $11, it's roughly 37,000 call contracts, which translates into about 3.7 million shares of potential hedging demand if the stock pushes through those levels.
And compared to normal trading volume, how meaningful is that?
It matters. Average daily volume is around 8.5 million shares, so 3.7 million is a material amount of stock that dealers might need to buy to hedge, especially in a short time frame.
Okay, so let's slow down. Explain gamma and dealer hedging without the jargon.
Sure. Think of dealers who sell calls as needing to stay neutral. If the stock crosses a strike where they're short calls, those calls become more sensitive to the stock. To remain hedged, dealers buy the underlying stock as the option moves toward being in the money. That buying can push the stock higher, which forces more buying. That feedback is what people call a gamma-driven move.
So the wall can turn into a launch pad if conditions line up?
Exactly. But, and this is important, being a loaded chain is not the same as an automatic squeeze. It needs three things to line up: price, volume, and time.
Walk us through those three.
Price first. You need a clean break above $9 at any point before the week closes, not just a midday pop. Volume second. Fresh call buying above the strike as the stock moves. If another couple thousand contracts print at $9 and $9.50, that compounds hedging demand. Time third. There are only 3 trading sessions left before that expiration, which makes the gamma response fast and steep.
So the three together create a fast-moving corridor?
Yes. If all 3 align, dealers buying into that move can push the stock toward about $9.50 to $10, where the next shelf of open interest sits. And on a longer expiry, a later ladder of options becomes more relevant as earnings approach.
Right.
But I mean, when you look at the data, the chain is only a setup. Most loaded option chains actually expire without incident.
So what kills it? What are the scenarios where this doesn't fire?
The biggest threat is macro, and that can veto the whole thing. For example, an escalation in the Middle East that spikes oil prices would push yields higher and send the speculative parts of the market into risk-off in a single session. In that case, the key level becomes $8, where there is a very large two-sided book, 17,722 calls and 6,360 puts on the same expiration. And that level can act like a magnet.
So a geo or rate shock overwhelms the options mechanics?
Exactly. And there's a quieter failure path, too. If the stock just stalls between about $8.50 and $8.95 through midweek without breaking $9, the structure slowly dissipates. Covered call selling from long-term holders can absorb dealer buying as well, preventing the compounding effect.
Interesting.
Yeah, that's a good point. Also, traders should remember time decay works against short-term option buyers when strikes stay out of the money.
What's the practical takeaway for someone watching this name over the next 3 sessions?
Watch 3 things. Does the stock break $9 cleanly? Does fresh call buying print on top of that break? And does the macro tape stay calm, meaning oil and yields behave and there are no big geopolitical headlines? If all those things align, the mechanics point higher into the next shelf of open interest. If not, the structure likely fades or reverses toward $8. So the real question here is whether the market gives the chain a chance to work. The options tell a story, but the tape writes the ending.
Great. Quick reminder, this is market structure analysis, not personalized advice, right?
Right. This discussion is for informational purposes only. Analysts note these mechanics frequently, but it is not a recommendation to buy or sell any security.
Perfect. Jessica, thanks for breaking that down so clearly.
My pleasure.
Before we go, 3 quick takeaways for listeners.
1. The options chain is loaded around $9, and that creates potential hedging demand of about 3.7 million shares between $9 and $11. 2. The setup needs a clean break above $9, fresh call buying, and a calm macro backdrop to accelerate. 3. A geopolitical shock or simple stall can turn the structure into nothing. Most chains expire without dramatic moves.
If you have questions about anything we discussed today, you can ask us directly at stockalpha.ai. We answer listener questions live. And for more market insights, head over to stockalpha.ai. Thanks for listening to Alpha Insights. I'm Hope, and thanks again, Jessica.
Thanks, Hope.